Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese. Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist. Taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors. And we are back with our first, I guess we'll call this Back to Normal podcast of the Facts versus Feelings podcast. Ryan and Sonu, Facts versus Feelings, episode 117 here. Sonu, we're titling this one, What We Got Right and What We Got Wrong in 2024. But hopefully people had a chance to listen to the previous podcast, last week's, I guess we'll say. We joined by Dr. Phil Pearlman, founder of the Pearl Institute. Amazing discussion about setting goals, moving your body, eating healthy, all that cool stuff that I think really makes sense this time of year, right? We all make goals and come up with things, and Phil helps explain how to stick with those goals and how to make them happen. So anyway, that was...
So are you still eating healthy? How did it go over the 2 weeks, over the holidays, right?
So we're snowed in. We have like a foot of snow, which is a lot of snow for Cincinnati. Like this, I can't remember the last time we had this much snow. So I'm just not eating. I can't go anywhere.
Living off canned soup. I mean,
yeah, we had some food, but had some Pop-Tarts yesterday. I know Phil's gonna yell at me, but that's like all I ate, I think.
Peanut butter jelly sandwiches.
I'm living. Yeah, some grilled cheese. So
there you go.
Had been eating healthy. It's just so darn hard. That week between Christmas and the New Year, you're hanging out and you're with friends. But I did an hour or 30 minutes on the treadmill just a little bit ago this morning.
Oh,
so
good for you.
Trying to keep it going. How about yourself? So you guys have a good holiday season? We haven't really touched base since holidays.
I know. It feels like a while. We haven't done this for a while, but
it has been a while.
No, it was good. I was down in Florida, Naples. I mean, and Sunday came back to Chicago. It's like I just walked my kids to school. I was telling Drew, a producer, that it's like about a half mile, just over a half mile walk to school. And yesterday it snowed a little bit, nothing like what you've gotten. Mm-hmm. And it's crazy. I walked back into the house and I'm sweating. It's so I'm drenched in sweat because I've got all these layers on me. You know how it is. And it's hard walking in their boots and the kids don't want to go. And it's like, I'm trying to push them along. Oh Lord, the winter is here. Basically, winter is here.
It is, and that's one thing I know about you. You'll sweat no matter what. It could be a blizzard, and you'll be the one guy that's sweating. Yeah, my kids, they're supposed to have school today, Tuesday the 7th, I guess, when we're recording this, and they already canceled. They canceled school because
they did. Because of the snow.
Yeah, and usually I'm like, they should have school. Definitely because of the snow. They should have school. But I'll tell you, when you have a driver who's sort of inexperienced, I'm kind of like, we weren't going to let her drive to school. We were going to drive her. So you know what? Whatever. What's one more day?
There you go. What's one more day? Stay at home, play the video games, watch TV.
Yeah, they're still in bed, so whatever. That's fine. So
good for them.
All right. Well, Sonu, I know we've got about 30-something minutes here, and we've got a hard stop. So let's kind of dive in. There's 3 things we want to talk about, and who knows? We might go some other angles as well. Didn't have a Santa Claus rally. Kind of some historic, honest to goodness, weakness to end the year. What in the world does that mean for the near term? What we got right and what we got wrong. We're going to spend a good amount of time there.
And we'll put an asterisk on that. We didn't get the Santa Claus rally, right? I know.
We're getting. No, we're getting into that. Oh yeah, we're going to talk about that. And then I wrote another blog, just 7 things to remember. These big picture things that are timeless. That every year when you go into a new calendar year, it's good to remember some of these things. We'll just touch on some of those things. So, all right. So, Sonu, let's see here.
What do you want to start with?
Well, let's start with kind of the market, I guess, and no Santa Claus. We talked a lot how historically the last 5 days of the year and the first 2 of the next year, that's called the Santa Claus rally. Well, we had some extreme weakness during the Santa Claus rally until a late big bounce on the last day. Stocks are still down, I believe, 80 basis points by the S&P 500, down about 80 basis points. And we have seen some weakness, at least specifically in January, some follow through. The previous 5 times we were negative, but last year we didn't have Santa Claus, and we were positive actually in January and had a really big year. So
was it the last 2 years or just last year? Maybe
so. Well, technically it's 2 years in a row now. We didn't have a Santa Claus rally, but again, last year did just fine. And believe me, these things are fun to talk about. It perks my interest when I know we're oversold going into it. You know it's historically bullish. It's like things changing a little bit. That's why I wanted to hand it to you, though. Yes, the stock market was lower.
Yes.
But when you peel back that onion, tell me, was everything lower?
No. Santa Claus came for the kids. Right, it didn't come for the grown-ups. I was joking.
Yep.
No, kind of, right? With the grown-ups. The grown-ups are your Magnificent Seven, we'll talk about that separately. Your NVIDIAs of the world, again, not a recommendation or anything like that when we talk about these individual stocks. But yeah, for growth stocks were, well, I'll say the stock market, the S&P 500 is down 0.5% over the Santa Claus rally. And Ryan, remind me again, the Santa Claus rally is the last 5 days of the year plus the first 2 days.
Plus the first 2 days.
See, I'm learning, right? And
ho ho ho. There you go.
Yeah, there we go. And so large growth stocks are down just under, just about 0.7% or so. But small caps, the Russell 2000, Santa Claus came with a few gifts. Just under a 1% rally for small cap stocks. Now, granted, this is after a pretty poor December. We talked about the Fed and Powell coming as the Grinch and all of that. December sucked, right? I mean, over the entire month, small caps are down 8.4%. Mid caps are down 7%. The large cap S&P 500 was down about 2.5%, something like that. So it was nice to see Santa Claus coming for, like I said, the kids.
Yeah, no, well said there. Just some more context around it. Like I said, we didn't see Santa Claus, but I've got this stuff somewhere. The last 5 days, so the last 5 trading days of the year, the S&P was down, first off, the final 4, but I just looked at the last 5 days. Down 1.5% those last 5 days. You could argue the last week, technically, of the year. Down 1.5% for the S&P. That was the worst since 2005. Only a handful of years, like 5 or 6, did we lose 1% or more the final 5 days. So right away, that's kind of rare. Also, the last day of the year was down, and the first day of the year was down. That was kind of all over social media, people pointing that out. Yeah. I took a look. That's actually happened the last 3 years in a row. Oh, no. Apologies. The last 3 times it's happened. Last 3 times it's happened. 2016, stocks gained 10% for that year. 2023 gained 24%. And then 24, stocks gained 23%. So I guess, So, I mean, I guess it has happened 3 years in a row then by that math. But the last couple times it's happened, things did okay. I mean, these are just, small slices and things to think about. I know Gepford over Cinnamon Trader had some stats along these lines. Kind of one of the worst endings to a year ever. I guess let's just remember we still gained 25% give or take on a total return basis. So let's not be too picky there. I don't think there's anything else I wanted to point. Oh, here's the last one, Sonu. We ended the year down 4 days in a row. Okay, down 4 days in a row to end the year. That was the longest losing streak to end a year for the S&P 500 since 5 in 1966. Okay,
really?
It is rare to see selling like that late in the year. So it is what it is. Now here, again, just is put some context around it. 1967, stock market gained 20%. So it's not like that was some big bearish signal, even though it's one signal. What else you want to talk about from the market point of view? Oh, by the way, what's next week's podcast? Why don't you share that? We're not going to talk too much markets because next week we're going to dive in. What's happening?
If you've been in this industry for even maybe 2 years, 3 years, but let alone 20, 30 years, you've heard the term animal spirits. And that's the theme for our 2025 outlook.
I didn't think we're supposed to give it away yet. I don't think we're supposed to give it away.
It's just a theme, but we'll talk about
only if you listen to this. You weren't supposed to know that. This is just for friends, close friends of the family.
We'll know who's listening, right?
There we go.
If they come back and say, "When are animal spirits?" Yes. But you've probably seen some promos on LinkedIn or X or something.
Teasers. I believe you call those teasers.
Teasers. Yeah, right. No, we're pumped for that. It's we've done a few of these. In fact, we're going to talk about a 2024 outlook and what we got right, what we got wrong. And I don't think anybody else, honestly, does that. I mean, it's rare people going back and revisiting their predictions. Sort of those just go by the wayside. But, we hold ourselves to what we, thought would happen. And it matters for portfolios too, right? I mean, it manifests itself in performance as well. And last year was pretty good. We'll talk about that. But keep an eye out for next week. Definitely put a pin in that. Come back next Wednesday morning. Hopefully you will have it on your drive out to work or your walk to school or whatever.
So we're gonna talk in code, Sonu. This is only for you and I because I haven't talked to you about it. So I did listen to a particular podcast recently. And this gentleman said, we turned bearish, I don't know, like last year. And I almost
You're
fell
gonna
over.
get my goat up.
I almost fell over. So bearish last year? No, you were bearish late 22. I know because I was on stage with someone who worked with you. Anyway, we'll just leave it there. It got me fired up. But it's what I'm getting at is if people make these predictions, and then a year later they just kind of say, never mind, or well, I didn't really say that, or no, I really
And you know
bearish.
what they said? I mean,
It's out there. It's out there with a quick Google search or whatever search, and I don't know. That's why I think what we're doing. Like, we'll get serious for a second. When I was hired 2.5 years ago, working with you and everything, we said we're not always gonna be right, and always gonna be wrong, but we want to be the most transparent research shop there is, right? And we've had some pretty good calls. We've been wrong some places. We're going to talk about that here during this podcast. But some places say, I wasn't even bearish until last year. That's not true at all. You were a raging bear all of 23. Okay. Like, it's out there. So don't try to change the narrative. And I think that's just one thing that we're trying to break that mold, because so many people do it, of just being honest about what we're really seeing out there. And if we don't know what we're seeing in August when everything was falling apart, we were not yin carry trade experts. Okay. Spoiler alert. You can go back and listen to the podcast we did then. We talked about reasons that it wasn't going to spiral out of control.
As a global macro strategist, I'm supposed to be a yen carry.
It's on the back of the resume. We're actually...
I'm not.
By the way, we're growing. So if anyone's interested in working on our team, check out carsongroup.com. Somewhere on that webpage, there's a hiring page. But we've been interviewing, looking at resumes, and it's amazing how qualified so many people are. A lot of great people out there.
Or just send it to facts versus feelings at carsongroup.com. We'll make sure we send you the correct link. Yeah, there you go.
That's a good way to put it. You can send anything to that email. That's a good point. But maybe it's like on the back, I'm a yin carry trade expert. But what I'm getting at is we explained what we were seeing in real time. And, I don't know. We're just trying to be honest. And I think we've had a pretty good run at it. So let's be more honest a little more. What else about the stock market? Then we'll talk about the other stuff.
Just two
catches
things.
Catches your interest here.
Looking back at 2024, I like to disaggregate things. Where do returns come from? Let's talk about two disaggregations. And we'll put up the chart on the screen. Go ahead, Ryan.
Yeah, the chart. I was going to say, I think we have a chart for this. So on YouTube, we are sharing more charts. So thank you to Drew, our producer, to make it more interactive. So we're going to have a chart coming up here in a second or two. Go ahead, Sonu.
So the S&P 500 total return, 25%, bang on 25%. I think it's 25.02 or something. This is the S&P 500 index, right, for 2024. You can break total returns into three pieces. How much come from earnings growth, especially looking ahead, right? Earnings growth forward 12-month earnings for the earnings per share for the S&P 500 went from $242 a share to $272. That by itself contributed 13 percentage points to the 25% return. Okay. The second piece is dividends. Everyone kind of ignores dividends, but dividends contributed about close to 2% of that. So 15 percentage points came from quote unquote fundamental profits, retained profits, as well as profits distributed in the form of dividends to shareholders. 10 percentage points, which is less than 15, by the way. Just in case. Yeah. Just to check my math there.
Still is.
10 percentage points came from multiple growth, multiple expansion. Everyone's talking about multiple expansion, things like that. Should we worry? And I'm not saying, things aren't stretched a little bit. Yes. But that's why you look at other pockets of the equity market. There's some value there. You don't put all your eggs into one basket. But even if you look back over the last 5 years, 2020 to 2024, right? S&P 500 has gained 97%. Of that, earnings growth has contributed 61 percentage points. Dividends have added 15 percentage points. So a total of 76 percentage points out of 97%. 5 years came from fundamentals, profits, right? Retained profits and profits distributed to shareholders. Multiple growth, yes, it did increase. Forward multiples on the S&P 500 is about 21.6x or something like that, which is similar to what we had 3 years ago, by the way. Multiple growth contributed 21 percentage points to that 97% gain. So that's, yes, things are stretched, but this is really, honestly, a story of profitability.
And I want to jump in there because, again, it's a similar podcast I was just talking about. The guest mentioned the last 2 years, S&P's up 60, 70%. Earnings are only up XYZ, whatever that number is. Not that large of a number. But if you go back 5 years, it's more impressive. But you point out something. Dividends are in there. I'll tell you, like I watch CNBC all day, Bloomberg, Fox, I watch them all. And the guests come on and do point this out. Earnings are only up here. It's not justifying things. But you pointed out dividends. Dividends are this quiet part that it feels like nobody is giving any respect to. And you just said it. Dividends added 15% the last 5 years. I mean, that's a lot. 15%. Why does no one include that? I never thought of this until you and I just had this conversation. But dividends count. I love how you share it, like the chart we just shared on the YouTube channel there.
And they compound, right? Like the 2% dividends that you got in 2020 compounded over the next 4 years. The 2% you got in 2021 compounded over the next 3 years. That's why over that whole 5-year period, dividends wasn't 2 plus 2 plus 2 plus 2 plus 2, 10%. It was actually less than 10% because S&P 500 dividends are not 2%. It's like 1.5 to 1.7, something like that. But the total contribution from dividends to the total return of 97% was 15 percentage points. Don't ignore dividends. I mean, over the short term, yes. I mean, when you look at your technicals, I mean, yeah, dividends are not going to matter too much.
Don't even care.
Right?
Don't care.
Like, yeah,
right.
exactly. But then over longer periods of time, it matters, right? And it's a way of, like I said, companies returning profits to shareholders. So that's one disaggregation. How do you break down that 25% return? The other one, everyone talks about the Mag 7, all of that, and they were all fantastic, right? NVIDIA up 171%, Meta up 68%, Tesla 63%, Amazon 44%, Google 36%, Apple 30%, right? And most
Did
of
you
that
memorize, or did you just read
no,
that?
No.
Okay. I was like, man, I know you're a machine, but I was like, okay, that makes me feel better.
I can't remember that, right?
I got you.
So off these,
I forgot. You know what? Time out. You know how
ahead.
you fill it? You buy something, you fill stuff out, and sometimes it says like give the 3-digit code of your credit card or the zip code. Honest to goodness, the other day I forgot my zip code. I don't know how. I've been here 2.5 years. I don't know. Anyway,
did he give you a Charlotte zip code?
I don't know what I was giving. I think I was combining Charlotte and Cincinnati. I don't know. I was smushing them, both Queen cities. So I smushed them together. So don't. I'm not judging if you forget stuff. I forget stuff all the time. So
no, I'm just reading this out to be clear, right?
There we go. Yeah.
So, but here's the thing: most of those returns, except Tesla is an exception, for most of these companies, a big portion of the return came from profitability, right? So I think that's the story. We'll put up a chart over here too. For NVIDIA, for example, out of the 171 percentage point, 171% return for 2024, 131 percentage points. 131 percentage points came from earnings growth.
Wow.
Right? Yes, there was some, valuation expansion there, multiple expansion, 40 percentage points, but it was all that. Microsoft was the laggard there, only up 12%. Oh, too bad, right? 16 percentage points came from profit growth. Multiples actually fell. Multiples dragged by 4 percentage points. Amazon, 66 percentage points came from profit growth. Multiples contracted. And so it had a 44% return, right? But anyway, all of going back to the S&P 500 gained 25%. These 7 stocks contributed 13 percentage points.
Okay.
Which means what? The remaining 493 stocks, contributed 12 percentage points, right?
So
if my math is right.
I think so. I think the math still works in 2025. So let's just point that out again, because we hear all the time, it's only 7 stocks. Go look at my X feed, my Twitter feed. You point, it's only 7 stocks. It's kind of like, does it still count? Like, is an investor still happy? Okay, okay, fine. And
I'm
used
happy.
It before. Yeah, the Michael Jordan example. Do the Bulls still win 7 championships with Michael Jordan? Yeah, they still count. I mean, last I checked, they still count. Where's it going with this? I was going on a rant. There it is. Yep, I know where I am. See, wheeling it back in here. The stock market, if you just take away the Magnificent 7, say they don't exist, the stock market still gained 12% last year. Your average year gains like a little bit over 9. So we still had a pretty significantly better year than average, 300 basis points, give or take. Not even including the leaders. Of course, your leaders should lead. That's how it works. People get so mad. Oh, this stock did great. This stock did great. Go back 100 years. This stock did great. This stock did great. It counts. It still counts. There's always leaders and there's always laggards. Let's be clear. Yep. But at the same time, just look at the median stock. Look at the all stock. It was a really good year. 11 sectors in the S&P 500. Every one of them higher. Materials was up 0.2%. I get it. That was really close. I mean, late year.
Touch and go there.
Yeah, materials really weak in December because of dollar strength. But nonetheless, all 11 sectors were higher last year. Okay. You had small caps up with 12, 13%. Yeah, mid caps up a little more. Large caps did better. We get it all. Tech did well again, NASDAQ and all that. But across the board, Sonu, there was a lot of strength, and the rest of those stocks, not named Mag 7, still were up double digits. I think that's something most people just don't realize. What do you want to add there?
No, and it was a story of profit growth. And where do profits come from? You can break it down in 2 pieces: sales and profit margins, right? Obviously, if nominal GDP is growing at 5%, you're going to get sales revenues growing, right?
Yep.
But you also had profit margins. I mean, that's where the productivity piece, maybe we'll get into what we got right, what we got wrong for 2024. The productivity piece, yes, it's in the macro data. It's noisy, but still it's there, right? Especially if you broaden your horizon. but companies have operating leverage. What does that mean? If you have operating leverage, you can grow profit margins when sales are growing. That's exactly what we've seen in 2023, but especially 2024, right? I think that's a really underrated story in my view. I think you and I have been writing about it, but
Oh yeah.
I think that continues. There's no reason why to think, unless we get a recession, which is not on the cards without giving away our outlook. But I don't think anyone listening to this was expecting us to call for a recession in 2025. But unless we have a recession, look, I think that continues. Productivity growth and margin growth.
So yeah, not in the U.S. Maybe there could be some recessions in Europe, different places, but not in the U.S. So I mean, I think I've got like 20 minutes. I've got a hard 20 minutes. So let's go to some of the things. You wrote a blog, again, carsongroup.com/research, and you can find it where you looked at 12 market calls we made this time a year ago. What we got right, what we got wrong. Obviously, we could spend 2 hours on this. We probably want to hit these kind of quickly, Sonu. But the first one was productivity growth. Means expansion will continue in 2024. Verdict, we nailed that one, and you were all over that. What about product growth?
Yeah, no, look, real GDP will clock in somewhere between 2.5%, 3%, 2024. And a big part of that is productivity growth. And that's why I think inflation's falling. And that's why I think the Fed should continue cutting. I'm worried they won't, but that's a different thing. We'll talk about that next week.
Yeah, exactly. Our proprietary LEI suggested expansion. There's other LEIs. You can find them, leading economic indicators that have been saying recession for years now. The one you created many, many moons ago said no, and we said consumption growth would remain strong because of real incomes. I would say we got that one right too, right?
Yeah, exactly. Our LEI never pointed to a recession in 2022, nor 2023.
And how about this, Drew? We'll put this right. We'll put that up right now. So we've got our LEI showing on the screen right now. Go ahead and talk about it for a second, Sonu.
There you go. And it's basically, when we talk about, there's a lot of economic indicators that come your way, right? ISM PMIs, yield curves. I mean, yield curve is a market indicator, but, housing starts, home building permits, all sorts of retail sales, auto sales. But, every time you get this, it's like, oh, this is good. This is bad. That's bad. That's very good. This is very bad. The LEI sort of combines everything and gives us a big picture. Okay, what is the total data telling us, right? And by the way, we don't do this just for the US. We do it for 28 other countries. It used to be 29. We've ignored Russia for now. So it's 29 countries. It used to be 30. But look, our LEI has been telling us that there's no sign of a recession, right? And in fact, we are more positive now than we were a year ago. Definitely much more positive now than we were 18 months ago. 18 months ago, we weren't saying there's a recession, but the probability may have been like 30% or 35%, right? Not our base case by any stretch of the imagination, but our LEI is, like I said, it holds us closer to the ground with respect to what's the collection of data telling us, right? So
exactly. We said cyclical headwinds from fixed investment fading, especially amid easing rates. Let's be honest, easing rates, we probably didn't get that one is right. What's the verdict on that one, you think?
Yeah, that was mixed. I was hoping housing would be a tailwind. Look, we did get Fed rate cuts, right? And we'll talk about that, right? We did get Fed rate cuts, but yields went up. That's something we didn't expect. We'll talk about that. I'm not including that here, within point number 3. But I thought we'd get more of housing activity. We didn't, but not a surprise given where rates are. We did get some investment spending from the CHIPS Act, IRA, all of that. But, ideally, I would just like to see that broaden out into more of the manufacturing sector as opposed to just manufacturing, construction, and equipment spending on the back of like high-tech equipment and semiconductor chips, things like that. So that one I would say was mixed.
And the reality, again, higher rates, you're probably not going to see that, right? So maybe next year or this year, maybe if we get a little lower rates, we can see that. Inflation in general continues to pull back. Obviously, we were saying that, honestly, started 23 and everyone talk about 9% inflation. So inflation is going to get better. There's reasons it can get better, but it continued to get better. But let's be honest, Sonu, everyone told us on TV in I'll call it the last 2 months or so, inflation was sticky. It's stubborn. It's still up, I don't know, whatever, close to 3, upper 2s, depending on your source. It's not that 2%. How do you rank what we said with our inflation calls?
I was going to say mostly correct. I didn't say, look, strictly speaking, we were correct, right? Core PC fell from 3.2 to 2.8.
I'd say so, yeah.
Core CPI pulled back from 4 to 3.3. So we said inflation will continue to pull back, and it did. But you know what? I'm still going to rate it as mostly correct as opposed to completely correct. Because, look, we were expecting more than that. Housing is a little more sticky than we expected.
Right.
We did get goods deflation, but, we are going to see housing disinflation continue, right? So that's anyway why I took away a few points.
Yeah, and
from that
I just had a quick color to that. I mean, we've beat a dead horse on this. Shelter, lagging. Something called Core Logic Single Family Rent Index, the SFRI. Seemed like I read that correctly.
That's right.
1.7% annual ending October. So this is again single family rents according to private data. 1.7% annual. That is from 2.3 a year ago, the lowest since June of 2020. So again, we've talked a lot about apartment lists and Zillow. Well, here's another one that is showing real-time rent prices are just dropping significantly. So and the government, what's the government still say rents running at 4.5, 5, something like that?
Yeah, 4.5, 5%.
Yeah. So real time, we know it's going to change. Okay, so we'll leave it there. Just a little color. Now this is an interesting one. Again, the Fed rate cuts. We said 3 or 4 cuts this year. I think at the start of the year, people kind of agreed there, but then by the second
start
quarter,
of the year, they were like 7 cuts. 7,
right.
Remember?
That's right.
A year ago today, probably a year ago today, it was like, oh, we'll go to, we're going to get 7 cuts. I think that was partly recession calls and things like that. Then by the middle of, I think somewhere in the summer, it was like, oh, we're getting only 1 cut.
Well, people were talking hikes. That's what I was going to say. The middle of the year, people were talking about hikes on interest rates, okay? And clearly that didn't happen because we had 100 basis points of cuts, technically 3 cuts. But kind of people look at it like I kind of call it 4 because it's 4.25s. I mean, whatever. We got 100 basis points of cuts, which interestingly, the 10-year is up 100 basis points since the Fed started cutting. Another story for another day. Maybe we can talk about that next week. But I think we did pretty well on this one, given we said 3 to 4, and that's what they did.
I think that's we kind of nailed that one, right?
Yeah.
I mean, 3 to 4 times. I mean, whether you look at 3 cuts or 4 25 basis point cuts, I mean, we got that. So. I honestly think, I mean, without, at the risk of being immodest, but, we're touting out.
Whatever.
Yeah, exactly. We don't get to do this too often, but, I think we're pretty good at watching what the Fed does and Fed expectations and all of that. And, again, promo for our outlook, discussion next week.
Yeah, exactly. Forward earnings continue to grow along with profit margins. I mean, I think we nailed that one, right?
Right. Yeah. $242, as I said, $242 per share was the next 12-month earnings. At the start of 2024, it ended the year at $272. Right? Like I said, that contributed 13 percentage points to the S&P 500's 25% gain. That's something which was frankly not a surprise to us.
Yeah, record, and again, we have record profit margins right now and record earnings. So there you go. I'll take this one. 7. The bull market should continue. Hey, we talked about it. I mean, obviously it did, right? Back-to-back 20% years. Just a little context. When you have a 20% gain, that following year is actually up like 10.5%, higher 82% of the time. That's better than your average year, which is up 72% of the time, up 9.5%. Back-to-back 20% gains. It's pretty darn rare. Only happened 4 times going back since 1950s. Once in the 50s. 3 times in the 90s. The year after back-to-back gains, 20% gains, on the S&P. Higher 4 to 4. Small sample size, sure. I'd still rather know than not know, with an average gain of 20%. All right, we're not calling for 20%. Spoiler alert for next week when we do our podcast. We'll talk about it, but we're still pretty optimistic, okay? But just some context around don't panic because we're up 20%. Okay, this is the one that,
all right.
First one wrong. Small mid-caps favored to move back into favor due to valuations and easing rates. Obviously, the easing rates didn't happen. That's probably one reason. But talk to me about small and mid. I guess we'll give ourselves a C there, maybe a D.
Yeah, or maybe a D. You know what? Give ourselves a D. Like maybe kind of
C minus.
Yeah, okay, C minus.
D's awfully harsh.
I'd say, but it's I wouldn't put it as F or let's say not even a D. Okay, I agree with the C.
Hey, they're still up. They're still double digits. I mean,
they're still double digits. Plus, this wasn't a big bet that we took.
Yeah.
Right. So it didn't impact the portfolio. Look, when we think about portfolio management, we have our neutral portfolios. Our colleague Barry Gilbert has written a great blog about this. If you just search for carsongroup.com, Barry Gilbert, neutral portfolios, you'll find it, right? If we don't have a lot of conviction, one way or the other, we don't want to overweight stocks, we think there's a recession, whatever it is. That's essentially what we'll hold, that neutral portfolio. And our neutral portfolio has mid caps and small caps. And relative to that, when we said, oh, we like mid and small and we're overweighting it, we always think about, okay, how much of, how big of a bet do we want to take in terms of, how much of that active risk do we want to occupy with, oh, we like small and mid. And it wasn't a big bet, right? It was a moderately sized bet, but it didn't hurt. Like you said, mid and small caps gained, I think, double digits, and mid was certainly a bigger bet than small too. And mid did better than small. So, I mean, Ryan, you probably get this all the time because you go on TV and say, oh, we like mid and small. And then everyone's like, oh, you guys got, your
You were
portfolios
wrong.
get destroyed. No, that's not how we manage portfolios,
Yeah.
right? So, and that's why I'm not giving myself, because ultimately, yes, these are calls. We want to get them right. But if we get them wrong, we want to make sure we are not hurt too much, because at the end of the day, these calls translate into portfolios.
Oh, absolutely. And again, people think it just means you have no tech exposure. Like, we've got a lot of tech exposure. Doesn't mean we are wild bulls on tech. We're not wildly overweight by any means, but we have a lot of tech exposure, a lot of communication services exposure in the models we run for our nearly 500 Carson advisors in 42 different states. And I believe we cracked $40 billion. I think we can publicly say that $40 billion AUM, thanks to growing. But hey, thanks to Mr. Stock Market too. It is what it is. But
doesn't hurt.
Growing. And if you're interested in learning more about us, go to carsongroup.com. We're growing. We have tons of advisors banging on the door, want to come check out what's going on. It's been a lot of fun, and in a bull market, it's even more fun. So definitely look into that. But yeah, small and mid, we'd say we didn't get that right.
What do we have? Number 9?
Yeah, we're at financials and energy favored. Obviously, that's probably mixed. Looking back, how did we do there?
Financials, second best performer. The sectors, I think it was up 30%, something like that. The S&P 500 is up 25%.
Right.
So, energy call, no question. We were wrong about that. But again, this is where we adapt, right? Like, we're not like, right. We're not holding that for the whole year and then closing our eyes or anything like that. I think we were out of energy. I mean, out of the sense we were underweight energy by February. I mean, yes, our outlook, if not even before, like somewhere around there.
And that's, we manage money first and foremost. So sometimes you come out with an outlook, and then, you know what, if the facts change, I change my opinion. What do you do, sir? A famous one. And we changed our tune on energy pretty darn quickly and actually went into communication services. We didn't like that as much, but then we said, okay, that's an area of tech and growth that we can ride with. And boy, that was the top performer. So anyway, so that's how this works. But again, these are calls at the start of the year, but we like to adapt around here. Number 10, intermediate maturity bonds outperform short maturity bonds.
He got it wrong.
As the Fed cuts. That's the key part. Fed didn't cut as much. Well, they cut some, but
they cut as much as they expected. Honestly,
then we had that late year rally on the 10-year.
I'll say we got this wrong. Like, I expected rates to more or less stay where they are, maybe get to 380, 375. It was 388 at the beginning of 2024, end of 2023. It finished the year at 450, 460, something like that. Right. Yeah. And so we were wrong. Plain and simple. But again, this goes back to, in terms of rating the call, I'd say, in a sense, it didn't matter too much. I mean, yes, we would have been literally better off in cash, right, than being in intermediate maturity bonds, treasuries, or something like that. But look, we manage portfolios. We want some protection. It's always just because something didn't happen, the risk didn't manifest, doesn't mean the risk didn't exist.
We enjoyed having some in August when the world was falling apart there for a couple of days. Exactly. It helped everybody sleep a little bit better knowing you had some of that exposure.
So even this call, I would say, even if we got it, we got it dead wrong. We were wrong, plain and simple. But I would rate it as a B or B minus or something like that. Maybe C plus, whatever, something like that. You get the idea. Because, one, we wanted as a portfolio diversifier. We were first of all, we were underweight bonds. We were max overweight,
that's the key fact. We might have been wrong, but we were way underweight bonds anyway. So it didn't hurt us as much.
And on top of that, we didn't bet all our diversifiers in treasuries either. We had exposure to gold. You and I have talked about that. We got into gold during that SVB crisis, March of 2023.
And then we added a little bit more gold after the election on that pullback. And the time we're doing this, I see gold up 1%. I said, "Ooh, I can live with that." So we still like gold here as a diversifier to ruin.
And then we have managed futures as well. To diversify. Yes, we expect inflation to fall, but it's not 1 or 0, right? There is a probability that maybe inflation is sticky, and maybe a few people are right, or there's I don't think inflation's sticky. So let's say that's a low probability event. But there could be an energy crisis or something. Who knows what could happen? And then we want those diversifiers to play a role that bonds will not play in the portfolio. So anyway, we got this wrong. We got the yield call wrong, but it didn't hurt our portfolios. And I would still, without the benefit of a crystal ball, I think we'd position the portfolios the same way.
Yeah, I tend to agree. And let's not forget, we had a little bit of gold, and gold is up 25% on the year, give or take, something like that. So I always looked at that little sliver of gold we had in our tactical models as kind of just a different way to play bonds, a different way to diversify, a different part of the bucket that's not stocks. So another call here. We got this one. I think we nailed this one. Credit likely to outperform treasuries, but we still preferred equity risk. And for the year, Barclays Ag, that's your bond, average bond, is up 1.1. I see high yield corporates up about 8%. So clearly, high yield did better than your treasuries and actually treasuries were virtually flat on the year. Treasuries virtually flat on the year. Ag up a tad. Anyway, what do you think there?
No, and this is an example where, like I said, the other call, we got it wrong, but I give it a C. This one, we got it dead right, right?
Yeah, exactly.
But instead of an A, I would give it a B because it didn't matter to us. Because we were like, you know what? Everything we believe in the economy is strong, no recession. So, high yield should do better than everything else, right? But then we would rather take that position in the equity market instead of high yield, right?
Exactly.
And that's what we did.
Yeah, no, exactly. I mean, I've always learned, if high yield is outperforming treasuries, that probably means there's no monster under their bed. I mean, we've been seeing on a relative basis. Once that starts to flip and you start to see worry, then you worry, I guess. The last one, number 12. I think we nailed this one. U.S. over international due to a stronger dollar amid stronger relative economic growth. That's best for last, I guess. You nailed that one, right?
This is one I think especially proud of the team because you want to be right, obviously, but you want to be right for the right reasons, right? Like, I imagine a lot of people listening to this are like, duh, I mean, why do you guys have any international, right? I mean, U.S. stocks are outperformed. Like, why bother? Like, we could have told you that. Like, U.S. stocks will outperform. And yes, I completely get it. But that's kind of looking in the rearview mirror, right? We want to have, especially when you come and listen to us, we have some sense of, okay, what's a forward-looking picture? Hey, you take even 2017, right? 2017 was a year when international stocks outperformed by a lot. And, we've talked about the dollar fell. That was a tailwind for international equities. There's some global growth picked up and things like that. We don't think that's well, I won't give an outlook away. We'll talk about that next week. Yeah. But again, this year, actually 2024, we thought, you know what? The U.S. economy is going to outshine everyone else, right? And that's going to keep rates relatively elevated. We still thought the Fed would cut, so don't get me wrong, right? But relatively elevated. And that's relative to everyone else in the world. Global growth is slowing down. We thought China's struggling, Europe's struggling. So those countries would have to cut rates probably more than the US. And all of this, what does that mean? That means the dollar is going to go up. And that means that's a headwind for international equities. And that's why we were underweight, right? Yes, we could have been underweight by just looking at the last 12, 15 years of data. But that's not, I mean, I'm not saying we don't look at that. We obviously look at that. But we had some sort of sense of what's the forward-looking picture here, and stronger dollar, better relative economic growth. That's why we overweighted the U.S.
Listen, there are a lot of big institutional research shops that employ 50-plus people, and I know this for a fact because I just know this for a fact, that were telling us all year, go to bonds. Bonds are going to beat stocks. You want to be diversified. You want to be in Europe. You want to be in EM. And here we are. So I know it's so obvious now. Oh, of course you want to be in U.S. A year ago, that's not what a lot of people were saying. Okay, I mean we were. So again, it's easy to change that narrative, but if you're invested in certain ways, then the narrative wasn't as accurate. But anyway, so all in all, Sonu, I've got it here because you wrote it in a blog. Out of the 12, we were correct on 7. 1 mostly correct, 2 we call mixed, and then 2 we got wrong. So overall, I'd say we had a pretty darn good year. Obviously, next week we're going to talk about our outlook for 2025. And if you want to hear the latest from us, don't forget to subscribe to our podcast. You can also leave a review. We love your feedback, and that helps with those algorithms. So please do that to help us. I was going to mention the 7. We don't have a ton of time. It's a problem.
Pick your favorite 2.
Yeah, I wrote.
I have my favorite, but you pick it.
Let me see. I did like 7 important things to know. Just go into every year as an investor. Go into every year expecting a double-digit decline, peak to trough at some point.
I was going to pick that.
Most years tend to see that. We didn't have one last year, I think 8% or so. We had a 10% the year before, remember, into late October of 23. That scared everybody. We had a bear market in 22. Don't think we had one in 21. Oh, last I checked in 2020, we had a 100-year pandemic. The stocks dropped 34% in 5 weeks. So just if you go into a year expecting a double-digit correction, and I tell you what, spoiler alert, I think we're going to have one this year. That's normal. It happens a lot of times. What also happens, we'll get more into it next week, you are normally higher on the year when you have a 10% correction. So let me just look at one more. We'll put this one up on the screen. It's just, don't get too worked up over politics. Looking at since 1900.
Yes.
Red or blue, blue or red, Green is with color that matters. We've had bull markets under all types of administrations, all types of backdrops in Congress. Yeah, I'd prefer a split Congress. 13 years in a row, the S&P's been higher. Last I checked, the House is really, really slim. And look what President Trump tried to get through recently. It wasn't as easy as people thought it'd be. So we still might have some gridlock in Washington. Gridlock can be a good thing. Don't get too worked up over politics. They matter, yes, but when it comes to your investments is what I should say. So those are the two timeless pieces that I think are important. Sonu, any others from that piece that you wanted to touch on, or did I hit them on all? What do you think?
This is my all-time favorite Brian Detrick chart. You know which one? Average is an average. The average usually doesn't happen, right? And especially relative to last year, after last year, 20% plus returns are, and I want to qualify this by saying we don't expect another the third year in a row, 20% plus.
Yeah.
Could happen, but generally 20% plus returns are not that uncommon. It happens about 30% of the time if you look at the last 75 years of data. In fact, it's happened more times than a negative year, than a red year, right? So if you get a positive year, it's more likely than not you get a double-digit return, and it could even be 20% plus.
And I'll just say it one more time. Since 1950, 22 times stocks have gained 20%, 21 times stock market's been down. The odds of a 20% gain are higher than a loss. I mean, it's kind of mind-boggling, but it's where we are. All right, Sonu, I definitely have to stop talking because I have to go. My friends, I'm big in Canada. Canada just loves me. I'm always on to Canada, BNN. They love me up there in Canada. They're good friends in Canada. So
don't go become the prime minister there now.
I heard that was my joke.
The job opening.
I was going to joke. I heard you guys have a job opening, but no. Anyone that knows me, I don't like politics. I don't get into it. I just kind of, I understand it matters. I understand it works up a lot of people. I just think it's all whatever. Some drama, but we have a great country being led by consumers. Things aren't perfect. Inflation's coming back. Things are still strong. We have strong productivity. We think it's going to keep going. That's what we're going to talk about next week. In the next Facts versus Feelings, where we release the Carson Investment Research 2025 Market Outlook. And Sonu already kind of revealed something. Maybe it's got to do with animal spirits. So anyway, with all that, everybody, thank you for listening. Thanks to Drew, our producer. We'll see everyone next week. Take care. Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.